Hi everyone, welcome to another video in the Accounting for Managers series. Okay, and in this video, I'm actually going to talk to you about the cash flow statement. Okay, and it is also a very important question answer for your term and examination as well. It was asked in multiple previous question papers. In even last year also it was asked. Okay, so this video I am doing it as a response to one of the comments which I got, which in where one of our classmates asked to explain about the cash flow statement. Okay, so this video is solely for that. So the question I said, right, the most recent in December 2021's paper also we found a question which related to cash flow statement. Okay, MMPC accounting for managers, this subject, the paper is, the subject itself is actually it is not a purely theory oriented paper. So this so even the latest we saw this question about cash flow was in the December 2021's term and examination. So this accounting for managers, this paper is actually not a completely pure theory oriented paper. Okay, it has practical questions as well, but I will assure you the pattern you have been seeing so far, even if you do not know how to prepare the trial balance or profit and loss statement or balance sheet or cash flow, what we have observed so far is that you will have enough theory questions to get you through with good marks. Okay, not full marks, but more than pass marks. So if you are not able to catch or how exactly you can do these problems by looking at certain transactions, do not panic. You will still, if you are thorough with the theory part of this whole thing, okay, you will still get good marks. You will still get pass, more than pass marks, that is for sure. And this is based on the past examination patterns. I'm hoping that this term also they will provide that facility for us. Okay, so the question that came in December 2021 is explain the basic structure of cash flow statement and describe the meaning of cash and cash equivalents. Okay, discuss in detail the type of activities that are taken into consideration for preparation of cash flow statement. So this entire question summarizes whatever you have studied or you are supposed to study in unit 4 of your block 1. Okay, that is what the unit which is related to cash flow. Okay, so let us get into what cash flow statement is. So before we learn about cash and cash flow statements, we need to know about cash and cash equivalents. Okay, so what is cash and cash equivalents, short formed as CCE? Okay, they can be termed as the most liquid current assets that are found on a business's balance sheet. Okay, so these cash, you know, right, physical cash, the money, the rupee notes, and cash equivalents are short term commitments. Okay, they are short term commitments with temporarily idle cash which is easily convertible into a non cash amount. So maybe cash receipts or something of that sort for periods less than 90 days. That is what we talk about when we are talking about easily convertible commitments. Okay, so one of the company's crucial health indicators is actually its ability to generate cash and cash equivalents. Okay, so when a company with relatively a high net asset, okay, but significantly less cash and cash equivalents, we can consider as mostly an indication of non-liquidity. Okay, so suppose you say that Reliance or some company, okay, some ABC company, their net asset is worth 1 crore, but cash in hand is less than 1 lakh, means the net asset value is actually maybe from the whole valuation of their building, the land, the machinery and everything. Okay, so that means even though their net asset is 1 crore, it is not liquidated. Okay, it is not liquid. If they have a requirement to get maybe a cash of 5 or 10 lakhs immediately, they will not be able to, because then they'll have to first maybe see which machinery they can sell, and then they'll have to actually sell it, and then only they'll get the money, right? Because cash CCE with them is very less. Okay, so that is why we can say that relatively high net asset but a very less cash or cash equivalent is an indication of non-liquidity. So from the investor point of view, okay, the company's CCE is generally counted to be the low risk, low return investment. Okay, so the reason being, see, if you have cash with you, okay, and if you put it in your savings account, it is low risk, right? Your bank is not going to get liquidated soon, right? We don't think a bank, most of the banks don't get liquidated by, I mean, all of a sudden on a very fine Monday. They don't decide that, okay, by end of day today I'm going to liquidate it. It doesn't happen. But at the same time, whatever money you have in your savings account, you can take it or put more into it whenever you want, correct? The bank is liable to pay it to you on demand. But the interest rate which you get for the money in savings account is very low, even compared when you're comparing it with an FD, right, which is low risk but a little bit higher return compared to your savings account, right? So that is why investors and companies, they consider the CCEs to be low risk and low return. And sometimes even analysts can estimate the company's ability to pay its bills in a short period of time by comparing its CCE and current liabilities. Okay, so but however, companies with a very big value of cash and cash equivalents are targets for takeovers also, because their excess cash will help buyers to finance their acquisition. Okay, and high cash reserves can indicate that the company is not effective at deploying its CCE resources. But for big companies, it might also be a sign of preparation for a substantial purchase as well, right? So if you have a lot of money, like if you have maybe 5 lakhs in your savings account, then it means that you are not properly investing your money, right? You could have put it as an FD, or you could have started some SIPs or something of that sort, or put it in the share market and get revenues from it more than what you would have got in your savings account, correct? So that is a sign of not properly deploying your cash, right? At the same time, if you are planning to buy a car soon, okay, if you're going to purchase a car maybe worth 10 lakhs, then naturally it is completely natural that you have that 5 lakh rupees in your savings account, because you will need it as down payment, right? Upfront payments. So the reason why cash flow statements are important is because it gives a very detailed about the spending, okay, as well as it helps maintain an optimum cash balance. It helps us focus on generating the cash, and it is useful for short term planning as well. So a disclaimer right now itself, let me say this video is gonna be quite lengthy. Okay, so if you do not have the patience, or if you don't think that you have the time to listen to me going on and on explaining to you about what cash statement is, you are more than welcome to pause the video and go to our Telegram channel to download this PPT. Okay, I am gonna upload this PPT in our Telegram channel. You can download it from there free of cost and study it at your own pace. I know the exams are quite near, every minute of yours is valuable. So in case you are going to do that, I would request you to please leave a like at least for this video, so that it will help me help you guys more, okay, in the coming days, in the coming months as well. Short request, I hope you guys will acknowledge it. So moving forward, cash flow statement. Now, there are three main types of financial statements prepared at the end of every financial year in a company. Okay, they are the balance sheet, the income statement, and our cash flow statement. These three statements together, they show the assets as well as liabilities of a business, its revenue, the costs, as well as the cash flows, okay, from operating, investing, as well as financing activities. Okay, so this CFS or cash flow statement, it is a financial statement which summarizes the movement of CCE, okay, cash and cash equivalents, that come in as well as go out of the company. So what CFS does is that it measures how well the company can manage its cash position. That is, how well the company can generate cash to pay its debt obligations and fund its operating expenses. It complements the balance sheet as well as the income statement. So it actually, you can say, think of it as something that paints a picture of how the company's operations are running, okay, where its money is coming from, and how that money is being spent by the company. So this CFS, it helps the creditors, that is the people who are willing to what you can say, give money to the company, determine how much cash is available, okay, and that is referred to as liquidity. So liquidity is a term which represents how much cash, or how much what monetary value you have right now, which can be put to immediate use. Okay, it is liquid, it can flow easily. Non-liquid means it is fixed, and it you can liquidate it. We say we can liquidate it, but it takes time. Okay, so like for example, land is a non-liquid asset. We can liquidate the value of, or we can liquidate the asset land by selling it, and when we liquidate it, we get the money which can be used for many other purposes. Okay, so that is liquidity and non-liquidity, for those if you are confused. Okay, so this CFS is therefore important for investors as well, because it tells them whether a company is on solid financial ground or not. So you can say that this statement helps the creditors as well as the investors to make more informed decisions about their investments, right? So a creditor giving you money is they are making an investment in you, right? So this cash flow statement, it is typically broken down into three sections. So if you look at the cash flow statement, you will find three sections. Okay, the first section will detail about all the operating activities. The second section will have all the details about the investing activities, and the third section will have the financial activities. Okay, so this operating activities, they detail cash flow that is generated once the company delivers its regular goods and services, that is regular day-to-day operating activities, how much cash comes in and goes out, like you make a sale or you make a purchase, all those things. Okay, investing activities means it is the cash flow from purchasing or selling assets, like you bought a new machinery or you sold some land, something of that sort. Okay, it could be both physical property like real estate, that is land or building, vehicles, or it could also be non-physical property like your patents and all. But the thing is, the purchasing or the selling should be done using free cash. Okay, you should not take debt, that is, you should not take a bank loan and then you purchase a machinery. That doesn't. Okay, whatever you money you had and you bought it, that comes. Okay, and then financial activities, they detail cash flow from both debt and equity financing. So let us look more into this classification of activities, that is operating, investing and financing. Okay, so first is the operating activity. So these are, as we said, right, these are the main or primary activities of the business, and it mainly deals with the major activities like buying and selling of goods or services of this business firm. Okay, it could include manufacturing, distributing, selling, marketing, all those things. And even though these activities does not include the investing and financing activities, it provides a major cash flow in the organization, right? So the major reason or the major way in which businesses make money is by selling their products, right? It could be physical products or service products, whatever it is, that is the major flow of money coming in, correct? So cash flow from operating activities can be represented as earnings before interest and tax plus the depreciation minus the tax and plus or minus the change in working capital. So, how cash inflows from operating activities is either through the receipt from sales of goods and services or cash receipt from the sale of patents. And outflows usually happen when payments are made on salaries or payments are made to the suppliers of our raw materials and things like that. Okay, investment activities, on the other hand, they are uh, they happen when cash is flowing in or out due to purchasing or sale of investments. Okay, they include money that is spent on long-term assets or shares, debentures, bonds, all those things. Okay, these activities, they provide minor cash flow only in the firm when compared with the operating activities, but they have a great impact on the profitability of the firm. So this cash flow from investment activities, they help in the growth of capital. Okay, and it also creates a stability in the firm. So inflow from investment activities could be when we have a sale of asset, or we received an interest on the loan, or advances given to third parties, or cash receipt received on the investment made in other companies, or receipts received on trading of shares, debentures, bonds, all those things. Okay, now outflow happens when we are purchasing long term assets and other intangible goods like patents, or we are making any payments on acquiring other companies shares or debentures or other debt issues, or we are giving advances or loans to third parties. That is when outflow happens. Okay, outflow means cash is going from us to somebody else. Now, the next is financing activities. So, financing activities, they can be defined as activities which involve rise in the company's capital. So, even though these lie at the bottom of the statement, it has its own importance. So, we said, right, first we write the operating activities cash flow, then we write down the investment activity cash flow, and then only we go and write, as the last step only, we write the financing activity. So, this is the format we should follow, okay, because it is what is accepted by the accounting association. So every accountant should follow the same method, or this format has to be followed. Okay, so these activities, they confine mainly on the financial activities like trading of a company's shares or repaying the investors, adding or changing loans, issuing more stock if it is required, all those things. Okay, so these change, actually these activities, they change the capital as well as the borrowings of the firm. So if you are to express this cash flow from financing activity as a formula, we would write it as cash flow from financing activity equals cash received from issuing shares or debts minus the cash paid as dividends and reacquiring of shares and debts. Okay, so inflow from financing activities, they happen when we are having a receipt on issuing of shares and other debt instruments, or when we are receiving cash by issuing debentures, loans, or other borrowings. Outflow happens when we pay interest on long-term borrowings and debtors, dividends, when we pay dividends to the shareholders of the company, or we repay the borrowings that were made by the firm, like we are repaying the bank loan or something like that. Okay, now how do we do this cash flow calculation? There are two methods to write or prepare this cash flow statement. First is the direct method, second is the indirect method. So when we are using the direct method, what we do is we only record the actual cash inflow and outflow. Okay, so they are actually, you can think of them as a very straightforward manner. Okay, we record all the cash payments and all the receipts. Okay, but indirect method, it is actually, so in this indirect method, we actually begin with writing down the net income or the loss from the income statement. Okay, and then we modify the figure using our balance sheet account to increase and decrease. Okay, and we compute the implicit cash inflows and outflows. So the indirect cash flow method is actually much what you can't say it is more beneficial or more better compared to direct method. It has both of them have their own advantages and disadvantages, but this indirect cash flow, it actually allows us to do a reconciliation between our income and balance sheet, right? We have three financial statement, we said income, balance sheet and cash flow statement. When we go by preparing cash flow statement using the indirect method, we can also have a reconciliation between our income and balance sheet as well. Okay, so yeah, now we are not going in depth into actually how we prepare the cash flow statement in the indirect or direct method, because that is a very vast topic and I might not be able to cover it before your term and examination, especially with all the other videos that are planned for discussing the important question papers and all for all the subjects. So please bear with me. So how do we interpret this cash flow statement? Now, whenever we review any financial statement, this interpretation of cash flow statement is what is crucial for us managers, okay? Because we will not be preparing these cash flow statements. Cash flow statements will be prepared by the accounting team in our finance department, but you will need to be able to read that cash flow statement properly and recognize what needs to be recognized and act upon the findings from these cash flow or balance sheet or this income statements. Okay, so interpreting cash flow statements is what you must know from an operating standpoint as managers of tomorrow. Okay, so whenever you review any financial statement, what you should consider is you should read it from the business perspective. Okay, so financial documents, because they are designed to provide insight into the financial health and status of the organization. Please, 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 while you are at your job, make sure that you follow this. Now, for example, in our cash flow statement itself, okay, the cash flow statement, it can reveal what phase a business is in, like whether it is a rapidly growing startup or is it matured or is it a profitable company, like that. Like we have, I believe it is in your marketing management, you will actually learn about the product life cycle. Okay, that life cycle also applies to your business. That is, every product in that, it's saying every product has a growth phase where it is initially launched, which slowly goes into a maturity state, which is kind of like a saturated, and then it declines. Okay, this is the product life cycle. This kind of a graph comes in. This graph is equally applicable to businesses. Every businesses start as a startup, then they mature, and then eventually they will decline. But the amount of time between this decline and your maturity, right? This we can expand by our innovations, okay, by different methods, even for products as well as businesses. This is what will our aim is to push our product or business into this maturity state and make it stay there as long as it is humanly possible. Okay, and it can also reveal whether the company is going through any transitions or a state of decline, right? So using this information as an investor, they might be able to decide whether the company is with uneven cash flow is too risky to invest in, or they may decide that the company with a positive cash flow is primed for growth. Okay, so similarly, a department head might look at the cash flow statement to understand how that particular department is contributing to the health and well-being of the company, and we can use that insight to adjust the department's activities. So this cash flow might also impact the internal decisions such as budgeting or the decisions to hire or even fire employees. This cash flow statement, it can be either positive, that is business is taking in more cash than it is expending, right? That is inflow is more. Okay, or it could be negative, that is business is spending more cash than it is receiving. Okay, so naturally we think that when we are getting more money than we are spending, it is good, and when we are spending more money than what we have, it is bad. Okay, so Positive cash flow, it indicates that the company has more money flowing into the business, right, than out of it for a specified period. So this is kind of like an ideal situation to be in, because having an excess of cash allows the company to reinvest in itself or its shareholders, settle the debt payments, and find new ways to grow the business. But what you must understand is that positive cash flow does not necessarily translate to profit. Okay, it does not necessarily translate to profit. Your business can be profitable without the cash flow being positive as well. You can have positive cash flow but without making actually any profit. So this is possible. And similarly, having a negative cash flow means you are using up more cash than what is coming to you. But it does not necessarily mean that profit is lost. Instead, it could be because because there is a expenditure and income mismatch. Okay, and you should make sure that you address it as soon as possible. Okay, and it could be because the company has decided to expand the business and invest in future growth as well. So it is important to analyze changes in the cash flow from one period to another, which can indicate how the company is performing overall, right? So like just like the example of the what can you say, the car purchase example I said, right? You might take a loan and then buy a 10 lakh worth car, but you might actually only be getting maybe 50,000 per month. It is possible. So when you think about it that way, you are spending more than what you're receiving, but it is necessarily not bad, right? It is, the reason why you did that is because you are expanding or you're gaining a new thing, right? Now, so again, limitations of cash flow statement. This is the thing. A negative cash flow statement, you should not think of it automatically as a red flag, but you should definitely take a look at what is causing this negative cash flow, right? Poor cash flow is sometimes the result of a company's decision to expand its business at a certain point of time, which actually would be a good thing for the future. Now, analyzing changes in the cash flow from one period to the next will give the investor actually a better idea of how the company is performing, okay, and whether a company may be on the brink of a bankruptcy or success. All these things we can identify. So CFS should also be considered in unison with the other two financial statements. You should not take just the income statement and decide, or just the balance sheet and decide. You should read all these three statements together and then make your decision. These are very important things from your work point of view as the future managers. So that is it about cash flow statements. I hope this video helped you in understanding what cash flow statement is. As I said earlier, I will be uploading these PPT in our Telegram channel. You can download it and study. All the best for your exams. I will try to cover as much as possible before your examination starts. Okay. So all the best, do well, and see you in the next video.